Zuzolo is back to Connected Farmer to talk about the June's USDA report that has brought less changes than expected. Right here on Connected Farmer, your channel to keep you up to date with the latest trends in agriculture and livestock. Stay tuned and don't forget to subscribe. Hello, Mike. How are you today? So the USDA has brought less changes than expected. What are your thoughts?
Well, it's a confirmation of declining world corn stocks, Luis, especially South American, and increasing soybean stocks, especially South American. And to a lesser degree, we saw the U.S. soybean ending stocks go up. And that may be, while the number's not that significant, we went from, I think, around 144. Let's say we went from 140 million bushels to 155 million. While that's not a significant jump, it does show us that we are effectively rationing demand at this stage. And so I think that's why the trade elected, both before the report and after the report, when it got confirmation, to really hit the soy complex pretty hard with some profit taking. And what you'll notice is in the November beans, the new crop beans, we still have quite a bit of weather premium because we're actually up near last month's high and up towards the monthly high right now for the month of June in November new crop. However, the July continues to fall. And before the report, the July was down about 15 cents on the week. The November was up about 25 cents. That spread only got wider as we saw the report numbers and digested them. So now the July-November spread in the soybeans is at its lowest level in many months, and the July Dees corn, July Nov bean spreads are almost equal to one another, trading around 80 to 85 cents. Still premium to the July, but that's a long way away from where we were in July beans minus November beans. So I'd put this report and classify it as a confirming or confirmation that we're not going to have as much competition in corn the next 6 months in the United States, especially in the export market. But soybeans, we will. The biggest problem continues to be for the corn, the wheat. And we saw once again, after the report closed the day down and we finished the day, the soft red wheat fell to 16 cents discount to the lead month corn. So wheat continues to be the biggest problem, the biggest competitor, the biggest nemesis to the corn market.
Yeah, so you think today's market reflects a reality from not just a picture from today, but for more of a long-term trend?
No, I really don't think so. I mean, in terms of what we have staring us in the face here in the United States, to make it maybe tangible to your listeners in South America, we have brewing and right around the corner, very close to the type and level of drought in our northern plains and upper Midwest areas of the United States that could become very similar to what you had experienced in Brazil this year for your second crop corn. And I would say we are moving closer towards a 2012 type scenario where there's going to be a very large region of the United States that is really going to drag down the national corn yield. And it was interesting, Luis, because after the WASDE report came out, the market sold off. But then about 10 minutes later, based upon when I hit the refresh button, the new USDA climate prediction ag in drought report is what it's called, was released for this week. And it blends together the drought monitor that we get from the climate people, and then USDA overlays that with the corn area, bean area, wheat areas of this country that are in drought. And Iowa went from about 45% drought last week for their corn up to 65%. And in beans, they're at 64% now. As a country, we have 35% of the corn in drought and 31% of the soybeans in drought here in the United States. That's up about 10% versus last week. If we miss these next rains, given the near 100-degree temperatures we're seeing in North Dakota and Minneapolis, Minnesota, that's the heart of the Western Corn Belt yield. I mean, that's really, especially as you get into southern Minnesota and Iowa, that's really where the Western Corn Belt yield is made. So if we have another week of hot, dry weather, it's going to be very difficult for the USDA to justify a 179.5 bushel yield on corn and almost a 50, 51, 52 bushel yield on soybeans. So to answer your question, I think this is still very much a moving target and that the supply is still falling faster than the demand until those rains come.
Yes, and I want to jump into your market advice. You have advised farmers to sell and defend as always. And I saw some news today that something that the market has talked for a while, that Mexico may be stalling its corn imports because of regulations regarding GMO corn. And for those who don't know, Mexico is one of the top importers of U.S. corn. So that can impact demand in the longer term.
Yeah, and this is, I think, in the shorter term, Luis, works very well into the idea. And I just released a special report on inflation and how it's going to likely work into the commodity markets here the second half of 2021. But this works very well into the idea and the premise that I have that countries, no matter where they are, if they are a major importer, whether it's China or Mexico, they're going to work their very hardest to break prices down and keep their food prices cheap. I think it's worth noting that this volume of corn and what the Mexicans typically will buy is in the 16 to 25 million metric ton range of what we're talking about here from what numbers I've looked at so far. You're just simply not going to be able to replace that and feed your livestock sector with anything else at this point because we have tight supplies, let alone we don't have hardly any non-GMO crops that would be able to supply that volume of demand for the livestock sector. So to me, this is a way to work down the prices potentially. Maybe the president of Mexico is very serious about becoming less reliant upon glyphosate and GMO maize, and that may be part of his long-term plan, but I just don't see it happening this year. And I think I'm not as nervous at all about the Mexicans not buying non-GMO corn, GMO corn and taking delivery of them. And it goes back to what the Chinese did last week, what Russia did last week as far as raising their export prices for wheat, limiting their export supplies for wheat. Now what Mexico's doing, all these things, Louise, mean less and less if it doesn't rain here in the United States. I mean, that's where you can do and say what you want, but if the supply is being cut because of drought, you're very limited as a buyer. And what you're going to have to do is rely upon less meat, and you're going to have to just bring your weights down and feed less meat. And I think that's the only way we can work ourselves out of this if the grain supplies remain very, very tight.
And corroborating with what you're saying, I saw a report about the producer price index in China, and that those raised by 8%, over 8% in 1 month there.
Yeah, this is the key to my inflation report, which I wrote last weekend before China released their PPI and before we released our consumer price index today as we go on the air. Both of these countries are dealing with the worst inflation since 2008. The Chinese are dealing with the worst inflation since 2008 on their PPI. As you noted, it's 9% now. The United States on their consumer price index, it hit 5% today. That's the worst number or the highest level since I believe August of 2008. So we are dealing with an inflation that is not going to go away anytime soon. And so what I proposed in my report to clients was this is not a transitory inflation pressure like the Federal Reserve likes to think or say it is. They're probably going to have to realize relatively soon that this inflation is going to hang around for several more months. And I think that's going to make them have to move on their monetary policy by the fourth quarter of this year. Maybe I'm wrong about that, Luis, but I have to put that into my marketing plan so that when they do, if they do make that move, I'm not caught off guard. So hedges and scale up selling is still what I preferably want to do with producer clients in the grain markets, but I want to do it with bought puts instead of cash related sales, because yield, as we said, is a wide open number right now, and we won't know much at all for another 10 days to see if these rains come in these very droughty areas. But the point of the whole thing of this market right now is we have the supply going down faster than the demand, but the demand is going down, and it's going to be pushed down by government policy the more this inflation lingers. We have to realize that that's what killed the markets in 2011 and 2012, and it historically is what typically will break the market back down. So we've got to be very conscious of that, and put that into our marketing plan so that we're not caught off guard again.
Some people are saying that those are the times of uncertainty, that there is more and more uncertainty. I would ask you, what happens if the Federal Reserve raises interest rates? That will turn everything upside down, which would be a game changer?
Yeah, I mean, this is where my inflation report's about 14 pages long, and I included a weather update in that. So I tried in a very small document of research to provide the reader and the marketer with enough information for me to say I feel comfortable in my research suggesting that the Federal Reserve, if they raise rates, that will create a higher bond yield. That higher bond yield in the treasury market will bleed over into emerging markets, and those emerging markets will suffer. Emerging markets and commodities are typically very closely tied to one another as far as both of them going up and down together. And it was just yesterday the World Bank put out a fresh report, their June Global Prospects report, and I noted that the fiscal stimulus by developed countries was about 15% of GDP. For high income countries, average or generally speaking, it was only, I think, around 5%, 3 or 5% for emerging markets. And so emerging markets have a lot of debt. They've stimulated their economy less. And so if the Federal Reserve makes a big shift, it could ripple through these economies very, very quickly and essentially turn off those investors that have been buying commodities because of inflation and because of the emerging market strength of commodity prices.
And still with the macroeconomic data, I was surprised with the numbers from Europe. They still show negative GDP for the first quarter.
Yeah, this is going to be probably the most uneven economic recovery since World War II, because that's really, I don't go back much farther than 1945 when it comes to the research I look at. But this is going to be one of the, if you always hear the term, this time is different. Well, it's typically not different, but I think one classification this time around is that the unevenness of the recovery could be pretty dramatic. Now, the issue could become then is if there's 3 or 4 major areas that don't recover quickly, does that drag down the rest of the world economy? Well, this goes back to the United States and China. They're the ones that have the greatest inflationary pressure, and they're the 2 largest economies in the world. I mean, obviously, Brazil has greater inflationary pressure. Argentina has much greater inflationary pressure, and even Russia probably has greater inflationary pressure than the United States and China. However, the United States and China together right now, because of the size of their economies, that inflation that they're dealing with being the worst since 13 years, going all the way back to 2008, that's going to have a bigger play in this market. So if we have a couple big countries or big areas like the European Union that slows down, it wouldn't surprise me that Asia slows down and then the United States slows down. And then all of a sudden we don't have the strong economic rebound that we were expecting. And that's probably something for another time to talk about, because I don't want to convolute things. Right now, it's a weather versus inflation, and it's going to be a battle between those two.
And your upside, you tend to think that the upside would be greater for corn and wheat compared to soybeans.
Yeah, one thing that I would say about the wheat and USDA's report that I'll be watching is our winter wheat crop conditions here in the United States are the second lowest in the last 5 years, but USDA has the winter wheat yield at the highest level, second highest level in 5 years. And so that doesn't match up, in my opinion. I would say the wheat is probably close to a low at this stage, and probably wants to try and put in a low here in the next 20 to 25 days, because we will be going into harvest. So once we get through that, I think that's when the upside potential increases for the corn market. My goal is still to get upwards of that 645, 650 level, test those old highs in December corn, and see if we can't get through, break through those levels. And if we can, give it another 25 or 40 cents. But if we fail at that point, because we'll be going into July, we're kind of getting into a time period where we don't want to press it as bulls, as longs in the market. We want to really take advantage of the hedges. So that's kind of the mindset I have in the corn. Beans, I would be working a lot more aggressively on hedges if these beans can't perform, especially if it rains. If it rains, I think the beans could actually pull the corn down.
Yes, if you want a deeper analysis, you have to sign up for a trial of Global Commodity Analytics. Thank you, Mike.
That's right. It's at globalcomresearch.com. That's globalcom with two M's, research.com. Thanks, Louis.